Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Intuit stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 151 billion market cap. They're trading at $5.40 a share and they have 280 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They just completed their 2023 fiscal year. Their fiscal year ends 7/31. And from 2020 to 2023, their free cash flow almost exactly doubled from 2.3 billion to 4.8 billion. Nice steady growth year after year. That's what you want to see. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that didn't go up as much. Maybe about 35%, 1.8 billion to 2.4 billion. Some reasons net income may not grow as fast as free cash flow is if the company passed through lots of write-downs, like asset impairments, goodwill impairments, fixed asset impairments, or maybe they pass through lots of stock-based compensation. Those are non-cash items that bring down your net income, but they don't affect cash flow. Revenue is a sales for the company, and that almost doubled from 7.7 billion to 14.4 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 149 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $125 billion. We divide that by 280 million shares. And we get a calculated stock price of $4.48. They're trading at $5.40, so they're trading at a 21% premium. It's a sell according to the model. The thing I like about this company is that so many people use their products. Most of the small businesses that have an accounting system use QuickBooks. And lots of the medium-sized businesses use Intuit QuickBooks. When a company gets big, like 10 or 20 million of annual revenue, they usually use a different software, something a little more robust. To give you an example, Oracle NetSuite is a popular one. There are 256 companies in the same industry as Intuit, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. In terms of CapEx, they spend a good amount, 280 million, a lot lower than Salesforce, and a lot lower than ServiceNow. But tech companies generally don't spend that much in CapEx. If you look at a manufacturing company like Taiwan Semiconductor, they probably spend over $30 billion a year. Or if you look at a company like Vale, they'll spend a lot in CapEx. Microsoft spends a lot in CapEx because they make computers. They do manufacturing in addition to all the services they offer. But Intuit doesn't really do manufacturing. They mainly just sell software. They have a good debt to equity ratio, 0.4. For every dollar of equity, they have 40 cents of debt. It looks like Zoom has no debt. They do pay a dividend on the smaller side, 0.6%, which is higher than the average, lower than the median. They generate lots of free cash flow. Salesforce is number 1 by a good amount. The only company bigger in this industry is Salesforce. Their price multiples aren't so great, although their price to free cash flow is better than the median, a lot better than the average. Their price to book and price to earnings are between the median average, but a 63 PE is pretty high, not so great. They generate lots of revenue. Look at Uber, number 1. The problem with Uber is their margins are so slim because every time they generate revenue, they need someone to drive that passenger. Intuit can sell their product 1,000 times and they need very little labor to do it, where a company like Uber is very labor intensive. And I do understand Uber does not pay its employees on a W-2, but those independent contractors who are driving do get a cut of the action. They do get a percentage of the fare. Intuit doesn't have to give anyone a cut. Of course they have employees, but they can scale much easier. So it's not so much apples to apples when you compare the revenue. And Intuit is still growing quite a bit, a 19% annual revenue growth rate. Look at Shopify, 49%. That's a really good growth rate. So they just released their 7/31 results last week. They beat earnings by 15%, revenue by 2.5%. They reported 165 EPS, earnings per share. That's net income, quarterly net income over shares outstanding. So if you annualize that number, it's $6.60 per share. And for the quarter, $2.7 billion of revenue. They beat their earnings now 4 straight quarters. They did miss revenue last quarter. They missed it by 1%. The last time they did a stock split was 17 years ago, a 2-for-1. They did a 3-for-1 in 99, a 2-for-1 in 95. That's their heyday. That's when they were growing a lot, mid to late 90s. If you put $10,000 into this company 10 years ago, you'd be really happy at $91,000 today. That's a 25% annual return. Although in mid-2020, your $10,000 would have been $110,000. But still, $91,000 is a great return. Let's take a look at their fourth quarter and full year financial results. They also give guidance for next year, 2024. Their revenue grew 13% in 2023 when you compare it to 2022. Small business is their bread and butter. That grew 24%. Like I said earlier, if you have an accounting software and you're a small business, it's very likely you use Intuit QuickBooks because it's very user-friendly. When your business gets a little more complex, or if you have a manufacturing company, you may want to use a different system. I do some consulting for a manufacturing company as their controller, and we use QuickBooks. QuickBooks has a lot of different versions. We use the enterprise version, which is good for manufacturing companies. As you know, most companies have a lot of different products. They own a lot of different businesses. But their main products are TurboTax, Credit Karma, QuickBooks, and MailChimp. You probably heard of most of these, at least 2 or 3 out of 4. Total revenue for all of 2023, $14.4 billion. Their small business and self-employed platform, that's $11 billion, a majority of their revenue. Their consumer group, that was $4.1 billion. Credit Karma, $1.6 billion. Operating income up 22% to $3.1 billion. EPS up 16% to $8.42. Just for the fourth quarter, revenue up 12% compared to the fourth quarter of 2022. Total revenue $2.7 billion. Credit Karma is down 11% to $424 million. The consumer group is also down 12% to $128 million. Here's a nice visual. Full year revenue $14.4 billion. Last year $12.7 billion. Operating income $3.1 billion to $2.6 billion. And EPS $8.42 compared to $7.28. That's for the full year. And this is for the quarter, $2.7 billion up from $2.4 billion. They had an operating loss last year. Now they have a gain of $17 million, which is pretty small. That's on a GAAP basis. Non-GAAP is $627 million. The way they calculate non-GAAP is they strip out things. A big one is stock-based compensation. TurboTax is down quite a bit. They sold 4.5 million units compared to 4.7 million last year. This is for all of 2023 compared to all of 2022. Online units is down also, 36 million. Last year was 38 million. Canada is up 5%. Last year 3.5 million, now it's 3.7 million. I guess not as many individuals are doing their taxes through TurboTax. They're probably using a different service, or maybe they're paying for an accountant to do it. And they talk about the decline in Credit Karma here. That's if you want to pull your credit report. That's driven by macroeconomic headwinds. That's a nice buzzword. And those headwinds are on personal loans, auto insurance, home loans, and auto loans. So if less people are applying for these loans, then it's less credit reports that are being pulled. That's partially offset by growth in credit cards, so more people applying for credit cards, as well as Credit Karma Money. Credit Karma Money is a way to get a high-interest savings loan. They have $3.7 billion of total cash and investments, debt of $6.1 billion, but a lot of this debt, $4.2 billion, is maturing over the next 15 months, so they're going to need to refinance that debt. They repurchased $2 billion of stock in 2023, and the board approved a new $2.3 billion, so they can purchase up to 3.8 billion shares next year. And they're paying a 90-cent quarterly dividend. That's payable on October 17th. That's a 15% increase from last year. Here's some guidance. It looks pretty conservative. Revenue of $16 billion, a growth of 11 to 12%. Operating income of $3.6 to $3.7 billion, a growth of 15 to 18%. And EPS of about $9.50, a growth of 11 to 15%. They're expecting growth in every category in 2024. The largest is small business and self-employed, 16 to 17%. Consumer growth, 7 to 8%. A growth in pro tax, 3 to 4%. And Credit Karma, they're expecting a decline of 3% up to a growth of 3%. So anywhere in that range. And for the first quarter of 2024, which is the quarter that ends 10/31/2023. They're expecting growth of 10 to 11%. EPS of 15 cents to 21 cents. $2.7 billion of revenue in the most recent quarter. 350 million products, 2.4 billion in services, which is up in both categories from last year. Their 2023 revenue grew in both categories, product and services, when compared to 2022. In order to generate the 350 million of revenue, it only cost them $16 million. You see how good the margins are? Because most of the software is on the cloud. People download it. They don't even need to make it and mail it like in the old days. So it's huge margins. Service revenue is also really good margins. 650 million of expenses, 2.4 billion of revenue. Marketing is their biggest expense, 840 million. R&D, 680 million. Total expenses, 2.7 billion. Interest of 68 million. That's the interest they pay in their debt. They receive 46 million of interest income on their investments. Net income 89 million compared to a loss of 56 million last year. So it looks like the fourth quarter, their fiscal fourth quarter, they don't generate much profit because all of 2023 they had 2.4 billion of profit. That means for the first 3 quarters of 2023 they had about 2.3 billion of net income. And for the final quarter of 2023 they added 89 million. So a really small EPS of only 32 cents. But for the whole year, 849. And they did decrease their shares outstanding, 282 million last year, 280 million this year. Of course, there's more on a diluted basis, 283 million. That's if everybody who owned convertible securities converted to equity, there would be 283 million shares outstanding. You can see they spend a lot on stock-based compensation, 448 million, up from 346 million last year. So when you look at GAAP operating income of 76 million, non-GAAP operating income of 660 million. The reason it looks so good on a non-GAAP basis is mainly because of stock-based compensation. They add back that 422 million. They add back the non-cash items. Amortization is 160 million. They do the same thing with GAAP net income and non-GAAP net income. They add or subtract the non-cash items. Or sometimes they add or subtract the one-off items, even if they're cash. This is their net income by quarter in 2023. In the first quarter of 2023, it was only 40 million. That's the quarter that ends October 31st, 2022. Then the quarter that ends January 31st, 2023, 168 million. Their big quarter during tax season is 2.1 billion. The quarter that ends 4/30/2023. And this most recent quarter, the quarter that ends 7/31/2023. Only 89 million. Let's look at their balance sheet. Current assets of 5.6 billion. Current liabilities of 3.8 billion, so they can easily cover their current liabilities with their current assets. Current assets are assets that can be liquidated into cash within 12 months. The most liquid asset is cash, 2.8 billion. Then investments, like if they invest in stocks or bonds, 800 million. Accounts receivable, 400 million. This is how much money other companies owe them because those companies bought on credit. Notes receivables, 687 million. This means they lend somebody money in the form of a note. So that's an asset on Intuit's balance sheet. It's debt on that other company's balance sheet. Their largest asset by far is goodwill, 14 billion. Goodwill is the premium you pay when you acquire another company. So 28 billion of total assets, similar to last year. In liabilities, 640 million of accounts payable. This is how much money they owe other companies for buying on credit. Deferred revenue, 920 million. This is when another company makes an advance payment to Intuit for buying a product or service. Most of this are customers who are paying a year up front for their QuickBooks service. Each month, their customers use their service. So Intuit removes a month of deferred revenue for all those customers and book it as revenue onto their income statement. All their deferred revenue is in the current asset section, because people pay for a year up front. They don't pay for multiple years up front. If they did, you'd see deferred revenue down here, which we don't. They do have 6.1 billion of debt, 10.5 billion of total liabilities, lower than last year of 11.3 billion. They're really profitable, equity of 17.3 billion, up from 16.4 billion. Let's look at their statement of cash flows. The way you calculate operating cash flow, you start with your net income. You add or subtract the non-cash items on the income statement. We add back 1.7 billion of stock-based compensation. We adjust for changes in working capital. and we get their operating cash flow, $5 billion. Last year was under $4 billion. This is for the fiscal year 2023 compared to fiscal year 2022. In their investing section, last year they spent $5.7 billion in business acquisitions. This year, only $33 million. They acquired MailChimp for $12 billion in September 2021. I wonder if part of this $5.7 billion is from MailChimp, because their 2022 fiscal year is 8/1/2021 through 7/31/2022. And this reflects the cash outflow from acquisitions. So let's just say they acquired a company for $10 billion, for example. $8 billion in cash and $2 billion in stock. You would only see $8 billion here, because this tracks cash, the statement of cash flows. In their financing section, they had a cash outflow of $4.3 billion. $2 billion of that are stock buybacks. $1 billion of that is repaying back debt, and $900 million of dividends. Let's take a look at the company on Simply Wall Street. Last price $536, $150 billion market cap, up 10% in the past week. So I guess investors really like their earnings. Up 24% in the past year. Let's learn a little more about the company. They provide financial and compliance products and services for consumers, small businesses, self-employed people, and accounting professionals in the US, Canada, and other countries. They have 4 segments: small business and self-employed, consumer, Credit Karma, and ProConnect. The small business and self-employed segment provides QuickBooks Online services and desktop software solutions comprising QuickBooks Online Advanced, a cloud-based solution, QuickBooks Enterprise, a hosted solution, QuickBooks Self-Employed solution, QuickBooks Commerce, a solution for product-based businesses, QuickBooks Online Accountant, and payroll solutions such as online payroll processing, direct deposit of paychecks, payroll reports, electronic payment of federal and state payroll taxes, and electronic filing of federal and state income tax returns. They offer payment processing solutions including credit and debit cards, Apple Pay, and ACH payment services, QuickBooks Cash Business Bank Account, and financial supplies and financing for small businesses. Their consumer segment provides TurboTax, that's income tax preparation, and personal finance. Credit Karma offers consumers with a personal finance platform that provides personalized recommendations of home, auto, and personal loans, as well as credit cards and insurance products. ProConnect provides Lacert, Pro Series, and Profile desktop tax preparation, software products, and ProConnect Tax online tax products. That's a tongue twister. Electronic tax filing services, and bank product and related services. It sells through various sales and distribution channels, including multi-channel shop and buy experiences, website and call centers, mobile application stores, and retail. They were founded 40 years ago in 1983, headquartered in Mountain View, California. It looks like they started trading in 1993. When you adjust for stock splits, it was $2.36. It was over $30 in 2000. Then the dot-com crash brought the stock down. It was cut in half, down to $16. Then it took about 9 years, from 2000 to 2009, to get past its all-time high. It's a painful 9 years. But if you held out, or if you bought in 2009, you would have had a really nice run. It broke through $300 in 2020. Then COVID hit. It fell to $200. Its all-time high was about $700 in November 2021. It got cut in half a few months later. It was down to $350 in May 2022. But it is coming back. It's well over $500 currently. Simply Wall Street has them at 606. They say the stock is 11.5% undervalued. 26 analysts priced this stock pretty much where it's trading at. Their trailing 12-month revenue in 2012 was $3.8 billion and had a pretty slow growth. It was still under $4 billion in 2015. Then it took 6 years to almost double, getting close to $8 billion in 2021, but blew up a lot from that point. It went from $8 billion to over $14 billion. And the forecast is for the revenue to hit $20.5 billion by 2026. This red line here is their debt. They had under $1 billion of debt from 2012 to 2020. Then they added a bunch of debt in mid-2020. It got to over $3 billion. They paid down some of that debt. It was down to $2 billion in 2021. Then they did some acquisitions and their debt got over $7 billion by the beginning of 2023. They did cut their debt down to a little over $6 billion currently, But you can see their equity is usually higher than their debt. Right now it's a lot higher. Their debt to equity ratio is only 35%. So 35% of their equity equals their debt. Their equity is $17.3 billion. 17.3 billion times 35% equals $6.12 billion. And this green line is their cash balance. So they do have a lot of cash, usually more than their debt, but currently their debt is a little higher than their cash. If you want to receive the dividend on October 17th, you have to buy the stock by October 4th. If you buy it on October 5th or after, you won't get that dividend. If you bought the stock, say 10 years ago, you will get this October dividend, assuming you hold the stock through the record date. And their record date is usually a week before their dividend. So I think October 11th will be their record date. So if you buy the stock on October 4th or before and still holding it by October 11th, you will get the October 17th dividend. If you bought the stock, say in 2022, and sold it on October 6th, you will not get the October 17th dividend. You have to hold it on the record date. I wish they would list a record date on this site, but for some reason, it's not here. It looks like they raised their dividend each year. They were paying 76 cents per share in 2013, and they raised it every single year. It got up to $1.88 in 2018. It's currently about $3.60. And the forecast is for them to pay $4.48 by 2026. And the yield is pegged to the stock price, so it doesn't always go up. If the stock price goes up a lot, the yield will go down, and vice versa. The yield was its highest in October 2015, 1.3%. It was only 0.5% in 2022. The forecast by 2026 is 0.8%. The CEO's annual salary is $1.1 million, total compensation $27 million. His tenure as CEO is 4.6 years. In the past 12 months, only insider selling, no buying. 85% of the company is held by institutions, 12% by the general public, and 3% by insiders. Their biggest shareholder is Vanguard at 9%. Then you have BlackRock. Their co-founder, Scott Cook, owns 2.5% of the company. He's also a director at eBay and Procter & Gamble. JP Morgan, 2.5%. Norges Bank, the central bank of Norway, owns over 1% of the company. BNY Mellon owns a little under 1%. Goldman, 0.8%. Invesco, 0.75%. Their employee count has doubled since 2013. It was 8,000. Now it's 17,000. The ticker trades on the Nasdaq, Xetra, Deutsche Börse, London Stock Exchange, the Bern Stock Exchange, that's located in Zurich, Switzerland, the Mexican Bolsa, Wiener Börse. The Wiener Börse is in Vienna, Austria. Then you have the Euro TLX, the BATS Europe, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.